Good evening, good morning, good night, wherever you're watching this transmission. This is Mike Martins. I want to do a quick Australian housing price update. Australian house prices keep falling. I got a few articles open up here. I went over different graph statistics, looking at the trend for the last 10 years, and things are all pointing downwards. Stress testing is taking its toll, even though a lot of people say it's a joke. It does exclude some people. Um, not enough, not unaffordability is one of the biggest factors that's playing here. And then now Sydney, Melbourne, more expensive cities turning into go cities, and then you got cities like Hobart, other cities start picking up steam because it's just more affordable to live out there, right? So, first article kicks it off right here, right off the bat, by the domain Sydney and Melbourne suburbs where the population is shrinking. This is from October 1st, 2018. Australia's booming population is making weekly headlines, but not everywhere is bursting at the seams. Take a closer look and you'll find there are neighborhoods in Melbourne and Sydney which have welcomed very few, if any, new residents in recent years, according to figures just released by the Australian Bureau of Statistics. Between 2012 and 2017, the national population grew by 8.2%. That's a lot of people, man. Or 1.9 million people. Melbourne absorbed roughly one third of that growth, while Sydney shouldered about a quarter, prompting concerns about livability and housing shortages along the eastern seaboard. But no one's they never factor in the same thing I keep bringing up like a broken record. What about the empty homes, the 150,000 empty homes in Sydney? Or units, homes, mixed, condos, townhomes, units, homes, empty, investor-owned properties. No one's looking at those properties that are abandoned and not abandoned, but just nobody lives there, right? They're just sitting on it as an investment. You know, once you start factoring in those and stop blaming supply versus demand, you know what I'm saying? But as dozens of inner city fringe suburbs struggle to keep up with the influx of new residents, others maintain a relatively stagnant population, and handful areas have actually shrunk. Sydney and Campbelltown region and Claymore Eagle Vale area lost 640 residents over the 5 year period, while the population is nearby Bradbury and Waterburn fell as much smaller of 37 people. But people die too. You gotta remember that, right? In Sydney, outer rest, the suburbs of Bleak Park and Windsor had 235 fewer residents in 2017, and they did in 2012. So that went down 235. I could bet you 100 to 1 that 235 people died in that city in the last 5 years. I'm not, you know, making fun of it. I'm just saying that's probably what happened, right? People aren't replacing the people that are dying off, right? Or the Australian proper isn't having children. That could be the problem right there. Meanwhile, the number of people living in Cherrybrook dropped from 19,650 to 19,522. That's not a lot. And where an additional 5,500 people moved into Kellyville, pushing the population to 25,360. So here it is. There's the suburb, and there's the change. And on the other spectrum, Cobbitty, Leppington, I hope I said that right, and Zealot B, let's call it that, Beaconsfield, are each welcomed by a whopping 14,000 new residents over a 5 year period, most of any Sydney region. So Melbourne. So it goes over the cities too in Melbourne, where the suburbs people are disappearing. Demographers say suburbs with declining populations are often reaching the end of the first suburb life cycle, with adult children moving out of the family home as opposed to residents leaving because they don't like the area. Suburbs that haven't experienced much population growth may have zoning regulations acting as a barrier to increased density. Yeah, there you go. There's the key right there. A lot of people rarely ever mention that. Domain research analyst Eliza Owen said the period between 2012 and 2017 was significant because it coincided with the tough through to peak of the latest Sydney and Melbourne housing cycle. I see at this time where house and unit values grew dramatically, but at the same time, many new units were established in the inner city areas, and the population generally seems to have persisted with inner city living. So, again, this article I think is designed, or it's put together to show people that, this is my opinion, I'm thinking they're putting this together to show people not to leave the cities because the suburbs are dying. Australian house prices could keep falling. Let's watch this thing. I hope there's no music on it. But let's see what what they have to say here. If it plays.
Rates up, houses down. In September, home values fell in 5 of our 8 capital cities. The problem is the downward trend in Sydney and Melbourne, where prices have fallen the most, and they're expected to keep on sliding.
So with mortgage rates just edging a little bit higher now, it does suggest that there's potentially some further dampening pressure on the housing market.
It's no surprise to us that prices are still falling at the moment. We think that's got quite a bit further to go, actually.
Sydney house prices fell another 0.8% last month. The annual fall is now more than 7.5%, or around $80,000. The median price is now $976,000. And as banks become more cautious in the wake of the Royal Commission, things could get worse as borrowing money becomes tougher.
The big driver of the slowdown, of course, is tighter credit conditions. We're not expecting credit conditions to ease up at all.
So the government is urging banks not to continue raising interest rates out of step with the Reserve Bank, because they know if the property market falls apart completely, it will undo otherwise strong economic conditions.
While we understand the cost of credit sometimes puts upward pressure, we don't expect them to be putting it up anytime soon.
We do think that if everything continues along this pathway, we think the RBA will be starting to increase interest rates around about this time next year as well.
For our national economy, one problem is the pace that prices are falling in our 2 largest cities.
So that starts to affect overall household wealth.
Ross Greenwood, 9 News.
So what have I been preaching forever since the time of Moses? I've been preaching the same thing. The Australian economy heavily tied to... Here, let me pause this. Oh no, it won't let me pause it. The Australian economy is heavily tied to its housing...
Federal Treasurer Scott...
Oh, housing crisis. Here we go. That's my title right there. Let's see what this guy has to say.
Scott Morrison today acknowledged that housing affordability in Australia is in crisis. It comes as new figures estimate that by next year, less than half of adults across the country will own a home.
The Treasurer responded bluntly after housing affordability fell 2.1% in the past year. While it's easier to buy in Perth and Darwin, where prices are falling, in Sydney, Melbourne, Adelaide and Brisbane, rising house prices undo the benefit of record low interest rates.
It is getting harder.
Despite losing the election, Labor says it will stick with its policies to try and give first home buyers a fairer go.
It's up to the government whether they want to drop their ridiculous and shrill scare campaign against Labor's sensible negative gearing and capital gains tax reforms. You don't fix the housing affordability crisis, if that's how it's termed, by driving up rents.
It really is quite a complex issue, but certainly we'd like to see home ownership rates for younger generations climbing back up again.
It's complex but urgent. A new study by the Melbourne Institute says currently 51.7% of adults own a home, but this will fall below 50% by next year.
The reason why it really boils down to one factor and one factor only, and that's housing affordability.
But there are warnings the answer is not to allow young home buyers to use their super to get a start.
If we had a flood of people accessing their superannuation for housing deposit, it's very likely that it would push up the cost of housing.
The result, younger buyers face difficult choices.
You need to have 2 jobs, and often you need one of those jobs to be quite flexible.
But for many hard-pressed families, that's often still not enough. It's something the Shackners know all too well. They've been renting for more than 10 years.
It seems even harder to get into the market with 3 children and childcare costs and all the rest of it, even with both of us working.
State governments say one answer to housing affordability are projects such as this one that integrate both private housing with social housing. But the big question is whether there are enough projects such as this one to truly improve housing affordability. Ross Greenwood, 9 News.
Keyword: affordability is out of reach for the average Australian. Plain and simple. Once the middle class stops buying, consumer confidence goes down, and let's not even go there.
Last week, the median
Rates
house
go
price
up.
in Sydney broke back through the $1 million.
Rates go up. Game over. A lot of people can't afford a $60 a month increase. Done. Problem solved. Rates are at astronomical record low levels. Australia's been having a bull run in their housing market pretty much since 1975. People are using their homes as ATM machines. People are leveraging. People are going against the equity. Too many people in Australia are going into retirement with a mortgage. So you're looking at a huge tug of war of problems to create the perfect storm. Now that Australia is so heavily hinged on its economy for housing, it's going to see a really tough time ahead in Q1. Right now it's springtime in Sydney and Melbourne. It's springtime, spring sales. So we're going to keep our fingers on the pulse and get a few guests on the show on trends in the housing market on Wednesday night, 6 p.m., 6:30 p.m. Western Seaboard time. A likely tighter lending environment following by the Bank of the Royal Commission, BRC, is expected to drive up property prices down further, with national house values registering 12 months of constant losses. Hey, what other cities like that? London's pushing 14 months of losses. Oh, they got 1 month of a little perk, and they went crazy in the media about it. Come in and buy. The dryness, the dip, the fall is over. And then some people looked at it and said, oh my God, pricing in London's going to go back up. It's been like 15 months. Oh, the ones that bought in went back down. Property consultant CoreLogic's National Home Value Index showed a broadening of housing market correction, with national values down 2.7% in September since peaking 12 months ago. So guys, I don't know if you guys saw my video on YouTube. I'm going to, if I remember to leave a link below, I really want you guys to see this because it's spot on. Everything's happening that I've said, especially if you're investing in markets. This is what my channel looks like. If you're investing in markets and stuff, or you're looking, like myself, I invest in the stock market semi-daily, twice, 3 times a week, back and forth. This one, I think it's under my housing predictions, or no, not housing, screw housing predictions. It's my my predictions right here. This is a really good video, guys, because I talk about how my predictions of where things are headed in the markets, and it's good. You guys have to see this. It talks about how I'm predicting the rise in interest rates, the fall in housing, in turn raising the bond market, in turn dropping the price of gold, in turn rallying the price of oil. I see oil going to $100 to $70 to $100 in the next 1 or 2 quarters, and it's happening. I've been looking at my portfolio. I've been slowly putting my money where my mouth is, watching it, dumping a bit of stock on the tech end, moving it into oil. It's going back up. So I just have a good feeling about this. I really recommend to watch this video. It's kind of long though, so I get to the point a couple of times where what's going to happen. Everything's happening to a T right now. So like I said, you're going to start to see interest rates go up. You're going to see housing collapse worldwide in English-speaking countries. The bond markets are going to be given back, returning a good 10-year yield. Oh, yeah. The currency, you'll see a huge currency crash. Not because all currencies are crashing. It's because they're all being hedged against the U.S. currency. So every currency will look like it's crashing, but it's not. It's just the U.S. dollar going up. And then now with the devaluation of the Chinese dollar, or the Chinese dollar slowly starting to devalue, China's the number one power purchaser on the planet is going to have to pay more for oil with a devalued currency. So they got to be. This is a huge meta game here that's happening here. It's a game, and it's a huge meta game, and it's all precisionally put in place. I just see oil going up to $100 at the end of the equation. All this equation I'm talking about at the end equals oil going up to $100 a barrel. So, and that will drive U.S. dollars, and that will drive the price of drive down the price of currencies. Banking Royal Commission will the credit squeeze become a credit crunch? Okay, following the release of the Banking Royal Commission's interim report, analysts are divided about just how much further the lending slowdown has gotten to. UBS analysts. So the Royal Commission they're basically a glorified word for auditors. They go in, they go look at banks' books, they look at what's on the books, they look at garbage, they complain, they say, why isn't this here, why isn't that, why isn't this policy in place, what the heck is going on here, why are you lending to this guy for, he hasn't worked in 10 years, things like that, you know what I'm saying? UBS analysts have long been bearish on the banks, and the interim report did nothing to change their view. The risk of the current credit squeeze turning into credit crunch is real and is rising in our view, they wrote. Remember, guys, biggest household debt in the world, and why I'm covering Australia, is Australia. Australia has the biggest loan to value. Even people that don't even own their homes, a lot of them are in credit card debt, student loan, like every kind of debt you could imagine, automotive debt. A lot of more people are living way beyond their means. So right here, we estimate that current improvements and tightening of underwriting standards, thank you, and the banks have reduced owner-occupied maximum borrowing capacity from 7 to 10% and investment property by 20%, they wrote. So underwriting is very important that you understand how it works. It's not the bank that approves it. It's not even the lender that approves your deal. It's the underwriting department that receives the email of the applied deal. So you go into a bank, you apply for a loan. The lender doesn't qualify to approve it. The branch manager doesn't qualify to approve it. It gets sent to an underwriting department, where a head office, where the underwriting department will look at it, look at the credit score, and then the underwriter's job is to look at it and say, okay, this deal looks fishy. Get him to give you more notice of assessments or more pay stubs from this job. Can you call and confirm employment? Then the underwriter will put that in his notes and reply to the lender. Okay, before you do this deal, the underwriter wants to see this stuff. And then you photocopy the stuff and send it to the underwriter. Then the underwriter will look at it again and say, okay, this deal is okay then. I just didn't understand the little blip in whatever. Or if he's got an R5 or an R6 or an R9, the lender's job is to tell the underwriter why he's got an R9, because the underwriter will look at the deal and say, well, we can't do this deal because he's behind on this. Then the lender's job is to ask the borrower why. So then the underwriter gets, because he has the ultimate say in the end whether the deal goes through or not, right? Therefore, there is likely to be further substantial tightening maximum borrowing capacity to come out for sure. Because a good underwriter will look at a deal and take into factor rates going up, because rates are historically low. A good underwriter will look, if this rate goes up 0.5%, this guy is underwater. Looking at all his credit cards, his blended rate debt, his lines of credit. So blended rate is like all his credit cards that he's paying, a blended rate. So then his line of credit, and then his car insurance and all that stuff. Once you start factoring in those expenses with what he's applying for, they're going to notice, okay, he could apply for this right now, but it's not comfortable. Give him another few months, and if rates go up 0.25%, he's toast. Unless he works a third or fourth job. So that's the problem. So let's see.
Financial services is the biggest single contributor to the Australian economy. It's worth around $140 billion every year. It's also the biggest sector of the share market. So this Royal Commission could have a big impact on the wealth of every Australian household. To work through what this interim report means, I was joined earlier by a panel of experts. Warren Hogan, currently an industry professor at the UTS Business School and formerly the chief economist at ANZ, the general manager at the Motley Fool, Scott Phillips, and Omkar Joshi from Regal Funds Management. Gentlemen, thank you for joining me. Warren Hogan, I might start with you. What are your first impressions?
Well, I think it's pretty much as expected, given the tone of what we've seen in the last 6 months or so. And the Commission has landed on two, I think, key things. And one is the performance of the regulator and the culture of the banks. And I think that's the direction we're heading in as we go into the final report. And I think that's going to be quite traumatic for the industry.
Scott Phillips, some scathing language from the Royal Commissioner, in particular pinning the banks as being driven by greed and trying to get a bigger share of customers' wallets. Why did we see bank shares go up?
Well, this is the interesting thing, Karen. So to Warren's point, lots of questions being asked. They've pointed out a couple of the key things. What's missing is any particular and concrete decisions or decision directions by the Commissioner to say, and this is what we'll do next. And so in some cases, the market has sold off the banks over the past couple of weeks. Right now, there's almost that relief rally of no particularly bad news, no particularly draconian decisions yet, and kicking the can down the road, if you like, is enough for the share price to jump today.
Omkar Joshi, is there anything in this which would indicate that the bank's business model is at threat?
There's definitely plenty of questions being asked today, so no recommendations, but there are definitely problems for the business models going forward. Yeah, they're talking about credit, how they assess it, should the HEM be used. That has some pretty serious repercussions in terms of mortgage lending, which is 2/3 of the balance sheets of the banks. They've also talked to advice. There's a whole heap of recommendations potentially that could come out of this, but today there's all questions, so still too early to tell.
Scott Phillips, I think one of the most surprising aspects of this report is that the regulators come in for a particularly ferocious thrashing from the Commission, and especially ASIC being pinned as instinctually going for a negotiated settlement at the top in their first interactions with the institutions, as opposed to taking them to court. Won't this mean, if the pressure is now on the regulators, that we're going to see more enforcement action, which is going to affect how much money these banks can make?
Yeah, I don't think the regulators can avoid it now. This is their first instinct, as you said, is to negotiate first. We call it regulatory capture. Let's be really clear here. They won't use the term, neither will the banks. The reality is, when it comes to, we've talked about it, allegations of banks working with ASIC to frame or APRA to frame press releases to frame the work that's being done. They've tried, rightly or wrongly, and I think wrongly, to work with the banks to try and say, well, let us help you do the right thing. That has clearly failed, and both regulators are going to have to, as a result of probably what the Commissioner will recommend when the final report comes out, but even if he doesn't from this report, to say from now on we need.
One thing that actually strikes me is, how come none of this stuff was, none of the, okay, I'm going to use this word, framework. Why wasn't this framework of a proper lending process put into place in the beginning? That's what really doesn't make sense to me. Why weren't things done right from the beginning to cover the bank's nut, to protect the customer's interests, but then it boils all the way back to what the beginning they said, it's greed. Because then now they're in these problems, and now they're going to have to issue refunds on homes, or they're going to probably have to, there's going to be a lot of problems here. So it goes back to malpractice, just bad workmanship. Like, unfortunately, you can't see the framework of financing like you see a house, right? This framework of this type of financing would look like this. You'd have gaps in between the windows won't sit right, door would fall off the hinge, the concrete foundation would be crooked. That's how the deals look like. To a professional, a loan analyst that will look at that, or an underwriter will look at those deals, he sees the same thing like you would see, and me and you would see a broken down car. Hold on a sec, this car is falling apart. Well, no, this is a good deal. No, but the car is falling apart. this is a good deal. And when I look at deals and looking at credit scores and looking for gaps and all that type of stuff, and skip tracing for credit issues and stuff, looking at pay and looking at the TDS and CGS, and looking at all different little things, I see that car too in a deal. I would look at the deal and say, wow, this is like a broken down car. This is horrible. The customer's not going to like this. But because you can't really see the framework on financing, it's really like, or a financial framework, it's hard to determine if that's a broken down car or a broken down house. You just see it and you sign. And that's the problem. That's been the problem the whole time. Westpac warns RBA of housing bust. So Westpac is telling the Royal Bank of Australia, the Reserve Bank board meets on October 2nd. The board's certain to keep the cash rate on hold. Yeah, of course. The last move in the cash rate was 25 basis point cut in August 2016. That followed 25 basis point cut in May of that year. As usual, during the long period of inactivity, our primary interest has not been in the outcome of the meeting by the commentary, both in the governor's statement and the minutes of each of the meetings. So they're looking at right here, back to 2.5% is just going to take us a bit of time. To try to get back to 2.5% very quickly, it would be mainly through people borrowing more money and having higher asset prices. So who is this coming from? This is coming from EBC Forum on Central Banking in Portugal. Viva Portugal. In June, Governor Lowe noted, I remain confident that we're going to get inflation back to 2.5%. It's just going to take a bit of time. To try to get back to 2.5% very quickly, it will be mainly through people borrowing more money and having higher asset prices. I think that's a much bigger risk in our economy than people having surprisingly low inflation expectations. Wow. He went on to note very high debt levels and asset prices are the number one domestic risk in Australia. So that's a guy from Portugal saying this. Me too, I'm from Portugal. To put that issue into perspective, the chart below shows that headline inflation in Australia's calendar year basis. So let's look at this year. Oh, there it is. There's the percentage rate per year and forecasts and Westpac economists. So they're forecasting it below. Sorry. That's it? All right, let's move on. Below 2%. That's where they're forecasting it, but we'll see what happens. Australian dollars, I think it's getting crushed right now. I haven't checked it in a few days. Australia's 3 great petrol ripoffs. Oh, that's for another day. We could talk about black market petrol. Housing market downturn, hardly a crash. Home values outlook a year from price peak. Uh-oh. If I remember right, it should be just in around 3%. It has been a year since home values in Australia major housing markets peaked. A year, guys. A year. So if you bought within that year, you're down because it's dropping. And experts predict that prices will continue to soften in years to come. Home values are down 2.7. Yeah, it was about 3%. I was right. Nationally since peaking in September last year, according to the last home value index from Property Analysis, CoreLogic. The correction is hardly a crash, CoreLogic said, representing a slower rate of decline relative to the previous housing market downturn, June 2010 and February 2012, when national dwellings values fell 3% over the first 12 months, declining 6.5% from peak. So, peak to trough, sorry. But here it is here. There it is, all the declines right across the board. And there's the quarter, and there's the annual. So Sydney is seeing one of the biggest annual declines of 6.1%, a total return of negative 3.2%, and the median value is $847,000. Followed by Melbourne, which has seen an annual decline of 3.4%, a total return 0.5%, median house price $697 large. So dwelling values are still rising on an annual basis in Brisbane, Adelaide, and Hobart. I mentioned those earlier. And Canberra. though the rate of capital gains have slowed noticeably according to CoreLogic. So here it is. Dwelling values from their respective historic peaks. And then you start seeing the rest of New South Wales and combined capitals and combined regionals and all of Australia. So it's not looking good. It's not looking good, guys. The current downturn remains mild considering nationally dwelling values skyrocketed 43.9% over the decade to June 2018, CoreLogic data reveals. Wow. During that time, the combined capital cities experienced prices increase of 52.6%, with the combined regional markets growing in value at 16.6%. Housing affordability improves as prices declines. Yes, because you need to borrow less to buy your purchase, and financing is the key. If you could finance it, you could buy it. If you can't finance it, you can't buy it. That's the key. Financing is the biggest factor in this. And people are now, with stress testing and the RBA cracking down on banks, a lot less people are going to be getting loans. Just don't qualify. Australia's housing correction marks its 12-month anniversary, with values down 2.7% since peaking in September last year. Australia's housing correction marks its 12-month anniversary, values 2.7%, peaking in September last year. So here it is again, same article, but different message. Same message, but different words. So that's CoreLogic's thing on it. I think this article was thrown up there purposely to tell people that small suburbs are shrinking, even though the housing is more affordable there. I think they're trying to get people stay in the cities. I think it's a lie. I think being in the big city is a lie. I don't know, guys. I don't know. I'm a small town guy now. I got out of the city. I just wasn't going anywhere in the city. I wasn't headed anywhere. So let me know what you guys think. Comment below. I'd like to know what you guys are thinking, especially down under. Don't forget the guys joining me on Wednesday for Trends in the Housing Market. I'll get to the Australia part at the end of the show because of time zone difference from people living in New York, people that call in from New York and Florida and Toronto. The problem is it's already late when I start the show and people are going to bed, where people in Australia and New Zealand, it's like lunchtime. So this way I could get the people out east first done. Then I could get the people out west where I am in California and other places done. And then we could go to Australia, and then we could go to New Zealand. And then I don't think UK, I have very little people from UK that could call in because it's like 5 a.m. there. So it's tough. It's tough for them. Anyways, let me know what you guys think. I want to thank everyone for all their messages and all the positive reinforcement, and I want to thank for everyone that's been tipping me. Thank you. If you're on PayPal, tip me, send me a tip. Anything helps the transmission. And I'm at 19. I think with AdSense, I'm at, with all the hours I put on YouTube, I think I'm at 12 cents an hour. So yeah, but message is important, guys. The message is important. Let me know. Comment below. Thanks for watching.